Hey, what's up guys? Omar here, broker and CEO of Alden Mortgage and OMA Realty. So this is going to be your mortgage rate update as of 12/10/2022. And then these companies all are saying that there's going to be a housing crash. Who are these companies? Well, first of all, I already knew that there was, because let's face it, the way that the pandemic has kind of segued into real estate homes or home prices just going so fast, so stupid, it is crazy. But I'm going to go ahead and let you know exactly how much they said it's going to do, how many. So there were 7 forecast models that were done, 7 of them, okay? Tentatively 7. There's probably a ton more. 13 models. What do the other 13 models say? Now, 70 of them are all leaning towards a crash. You'll be shocked of exactly who says it, because I never thought in the history of my life, even though I make these predictions and whenever something happens in my world, right, I look at myself and I'm thinking, you know what, if this doesn't make sense to me, which is common sense, right? If this doesn't make sense to me, well, what is going to be the final outcome of it? Then you could plug and play some numbers based off of exactly, you know, what your ideas are. But let's get on with the mortgage rate update, and then we're going to go ahead and talk about, is there going to be a mortgage crash? Not a mortgage crash. Is there going to be a real estate crash? If it is, what's going to cause it? How much is it going to be? Let's go ahead and compare it back to 2008, because that's the only thing we could compare it to. But as of 12/10/2022, 30-year fix will be sitting at 5.64%. 15-year fix will be sitting at 5.08%. 30-year I-balance will be sitting at 5.58%. DSCR loan will be sitting at 8.75%. Bank statement loan will be sitting at 8.68%. FHA 30-year fix will be sitting at 5.14%. 7/6 adjustable rate mortgage will be sitting at 6.04%. USDA 30-year fix will be sitting at 5.19%. VA 30-year fix will be sitting at 5.20%. Hard money fix and flip will be sitting at 9.85%. You see a distressed property, you want to go ahead and jazz it up, fix it. You want to turn a pretty penny profit on that guy. Link in the description below. Now the hard money fix and flip, just so you know, they're short-term loans. Don't get crazy. If anybody offers you a long-term hard money loan, run away. You don't want to be part of that. Just go ahead and go. But if you are interested in any one of those mortgage products, link in the description below. Up to 50% commission rebate on buying your next home. 0% listing on selling your current home, or any mortgage assistance. Link in the description below. DM me on Instagram or comment, or you know what? I'm still new. I'm a 40-year-old man. I don't know everything that it has to do when it comes to this social media stuff. I'll get better. I swear to God. Like, subscribe, comment, do all of that, because the more money I make, well, I don't make anything off of this. The only thing that I did, I made about 130 based off of referrals that my videos thing. So they're actually working. They're amazing. Social media is freaking insane. I just should have taken that 130,000 and just dumped it all back into this video thing. But my YouTube channel will be 100% organic. I will not buy followers. I will not buy subscribers, even though you get bombarded by these little sons of guns every single day. They just, we'll get you 10,000 watch hours, 4,000 subscribers, this and that. We'll go get you to 100,000 in like a month. I'll do this by myself. I don't need that. But let's get on with it. 20% home value price decline. 7 forecast models are leaning towards a crash, and 13 models are saying that it's going to be an ongoing thing through 2023. Now, the only thing that we could compare it to, okay, back in the 2000s, we had the housing crash of 2008, which it wasn't really in 2008. It actually started back in 2006. Now, I'm going to go ahead and use 2006, and you could kind of plug and play for right now, because I'm going to compare the last 2 years, 2020, 21, 22, into 2006, 7, and 8, and how it takes some time, because in real estate, everything takes so long. And I am not the only one that says that there's going to be a recession. I deal with investors, and when I'm talking about I deal with investors, I'm talking about like not people with millions behind their name. I'm talking about B's. And it's like every single person that I know is really, really worried, really, really, really scared, especially for those companies that are back holding projects that they have not completed yet. And I'm not talking about little projects like your little flip here or little flip there. I'm talking about pretty good sized projects where they're not going to have the same value that they projected in the future. And one of the biggest real estate personalities out there, I'm not the only one, the biggest personality, real estate personality out there by leaps and bounds is going to be Grant Cardone. Grant Cardone, he's a real estate syndicate. He does huge syndication when it comes to real estate and investing and building commercial properties and all of this. This guy's been doing social media since, I don't even know how old this guy is anymore. But here's what he said on this podcast that he was with this guy with really, really nice hair. I don't know who the guy is, but watch this.
This is probably the scariest recession we'll have since the 70s.
Yeah, I was talking to a bunch of guys who've been around way longer than me. Everybody I talk to is more scared right now than they'd ever been.
Yeah, and the only thing that anybody ever says is, oh, interest rates needed to get back to normal. Okay, look, that is a terrible argument. The price of a home in the 1970s was 80 grand. Here in this town, it's 5 times. Normal is not from 3% to 7% because you got 5 times the price to support.
Right.
And you do not have 5 times the wages because wages are flat. Now they're trying to pull them down and get unemployment. I don't know, man. This is probably...
So since you guys know that I am not the only one, back in 2006 is when the whole market correction happened. So let's take 2006 and then plug and play it to 2020. Now, before that, we were doing what's called subprime mortgages, negative amortized loans. We were doing a bunch of these subprime loans, which we still have, also known as adjustable rate mortgages, but now there's a difference. There's a cap. A cap means that every year the Fannie Mae, Freddie Mac, majority of the time, now don't quote me on this because sometimes things happen with different lenders and I can't speak for everybody, but I will speak for myself. When you have an adjustable rate mortgage, even though this is considered a subprime mortgage, you have, like, let's say, for instance, you do, for the sake of argument, you do an adjustable rate mortgage, you do a 10-1, and then there's one that you don't see, a number that you don't see. We do what's called a 10-1-1, right? Or we have a 7-6-1. Or we'll have like whatever it is, right? So that means that number one, we'll do the 7-6 because that's what I did in my mortgage rate update. 7 is going to be 7 years, which could either be interest only or it could be fixed payment principal and interest for the duration of the 7 years. The number 2, which will be the 6. Now, if you see a 6 and or a 1, if you see like a 1 there or a 2 there, or sometimes you might even see a 5, but if you see a 6 there, that is typically means that it gets adjusted every 6 months after that 7-year fixed term is over. Then you have a 1. The 1 is going to be the total percentage that is allowable for it to increase at each and every stepping point, every 6 months that it gets adjusted based off of the market rates that we are at. Now that we got that all out of the way, now subprime mortgages back in the day in 2006, they were kind of collapsing. Everybody kind of knew it was I didn't. I was a young guy. I was making so much money, more money than I could possibly even imagine. Back in the day, we thought that we were going to be living off of this high life for as long as God knows how, and then everything came crumbling down. But in 2006, and the reason why I'm comparing it, because in 2006 we had subprime mortgages. Well, in 2020 we don't have subprime mortgages. Okay, back in the day, in 2007, 2008, we started having an influx in inventory, like this whole like gluttony of inventory. Well, because we had foreclosures, right? Well, we don't really have that right now. So in common sense mind, right? In a common sense mind, this means that we should not have a housing correction at all. We should not be in a crash, but it is going to be. Because number one, back in 2008, when the crash finally hit the market, because the crash started in 2007, it just didn't hit the stock market back until 2008. The problem with people is that they think that real estate is correlated just to real estate. It's not. It has nothing to do with real estate at all. The subprime mortgages did kind of have a big effect, but that went into the secondary market, which is the stock market. The stock market depicts where home prices are going to go, because in order for people to buy homes, you have to have a healthy company and a healthy economy. You have a healthy economy and you are all good. Now, layoffs are happening by the thousands. And I'm not talking about your everyday run-of-the-mill type of job that's paying you like $40,000, $50,000, $60,000 a year. I'm talking about houses, especially here in California, $150,000, $200,000 and plus jobs a year. those are decreasing by a lot because we are heavy in tech, we are heavy in building, we are heavy in real estate, and we are all tanking. I know I am. I'm not gonna. I am humbled enough to say that we are taking one of the biggest hits. Like the last time I remember taking a hit this big was back in 2007. 2007, 2008. That's when we really felt it. Like it seems kind of coinciding. Now, there's something else that happened that did not happen in 2008. In 2008, 7, or leading to 2008, is that the home prices didn't increase as quickly as it did. Now, where's my little thingamadooger? Now, inventory still remains below pre-pandemic level, but increased inventory has already hit the market. You know where we're at pre-pandemic, during the pandemic? We're inventory. So that means that if, like, let's say, so to kind of give you an understanding, we had 0.7 months of inventory in 2019, 2020. That means we had about 3 weeks worth of inventory. That means that if we stop selling today, in 3 weeks, we would run out of homes completely to go ahead and for anybody to buy. That is insane. We're typically, to be in a healthy economy, we like to see between 6 and 8 months worth. Right now, we increased from the 0.7 all the way up to, I think we're about 3.3 to 3.5, depending on the area that you are. But there's places that are taking huge, huge hits. Now, I'm not the only one that is saying that we're going to have a big correction. Want to know some of the other people that are that's saying that we're going to be having a big correction? Morgan Stanley sounds familiar. Zonda, which you probably won't know about. KPMG. Let me see. One that Goldman Sachs. Goldman Sachs is one of them. Redfin. Wells Fargo. Fannie Mae. All of these people are saying that we're going to go ahead and have a housing correction. Some are speculating between 25 to 28%, which is 2008 levels. Now, if anybody saw some of my previous videos, you know that the correction period for it to go ahead and equalize again, that means that the home prices from 2007 to go ahead and bounce back up took about 8 years, 7, 8 years, somewhere around there, for it to to be level again. Now, we are probably going to be in a slow burn for the next 3 years. Could there still be deals like found out there? Yeah, of course there can be. Is still right now a bad time to buy? That's all subjective to you and your personal, what you're trying to do. If you're trying to hold off, then go ahead and hold off. Do we see interest rates increasing? Yes, we do. Of course we do. We have another Fed fund rate increase coming up in here in a little bit. And whatever idiot says that the Fed fund rate has nothing to do with mortgages, well, yes, it does. Of course it does. It 1,000% does. Then if it didn't, explain this to me. Why are interest rates going up there, sunshine? Explain that to me. Because the Fed fund rate is the amount that the Federal Reserve charges banks to go ahead and buy and sell money to whatever credit that you're lending out there. That's how the world works. So they are anticipating about 20% drop. I am going to go ahead and kind of jump on board with that. I think 20 to 23% is going to be respectable numbers for you to go ahead and anticipate real estate housing prices are going to drop as interest rates do increase. Interest rates decrease because you want to know what happened after 2008? After 2008, interest rates decreased. Then in 2010, the Dodd-Frank rule came in to kind of regulate the stock market. The CFPB was implemented. The CFPB is a Consumer Financial Protection Bureau that kind of regulates all of us. Banks, credit unions, mortgage brokers, anybody that lends credit, it regulates all of us. So if you work at JP Morgan Chase, trust me, you're doing the same exact thing as Wells Fargo is, because JP Morgan Chase didn't make up the rules that you're following. The CFPB is, and you're just following them because you're a banking institution, a depository institution. But that's going to be it for the mortgage rate update. 50% commission rebate, 0% listing on selling your current home or any mortgage assistance. Link in the description below. Until next video, guys, I really appreciate you watching.